So, good afternoon again. So, this panel, which is really about market barriers to financial integration, is, and has always been for as long as I can remember, a staple of any post-trade conference. What are the barriers to market integration, and what can we do about those barriers? And when we prepared this, and I will just hand over to my panel to introduce themselves in a moment, when we prepared this, we thought, well, you know, it's 30 years, 25 years since the Lamfalussy report and the Giovannini report, which sought to really frame this question of what regulators and market infrastructure could do or should do in order to facilitate the faster, more efficient movement of capital across borders. And I'm blessed today to have not just CSDs on this panel, though we have two of them, but we also have a card-carrying investor and issuer, and we have a central bank. So without further ado, I'm going to hand over to Vojtěch to introduce yourself, and then we'll move on to the substance of the panel.
So thank you very much. My name is Vojtěch. I'm head of Regulation and Internal Cooperation Department here within the Czech National Bank. I'm very glad to be here, and I'm glad also that we could offer this space, this building for organizing this conference, which is part of the Czech National Bank. I'm representing also Czech National Bank within the ESMA, European Securities Regulator, but I have to admit, or I have to underline that I'm not representing ESMA here, I'm representing just the Czech National Bank. Thank you.
Hi, you can't hear me? Yes, you can hear me.
Yes, we can.
I'm Jim Turnbull. I'm the Deputy Director of Capital and Financial Markets at EBRD. My background is obviously as an investor and trader previously, but I will also look after the areas of capital market infrastructure within our countries of operations.
I'm Indars, the CEO of Nasdaq CSD and also Vice Chair of ECSDA. Nasdaq CSD operates in 4 markets in 3 Baltic countries, Estonia, Lithuania, and Latvia, and also in Iceland. And the unique element is that we cover all 4 markets with one CSD license.
Thank you. That is my older brother, by the way. It's me, I'm just kidding. Abdulla Abdin, I'm the Chief Operating Officer of Bahrain Clear and the Chairman of AMEDA, African Middle East Depository Association. And luckily today I've been elected as the Vice Chairman of WFC. Thank you.
Congratulations to Abdullah. So we thought that we would start by indeed taking a retrospective look and saying, you know, after a quarter of a century of focus on this question of barriers to interoperability, barriers to capital movements, in what ways do regulation and indeed the practices of financial market infrastructure, of CSDs, continue to represent barriers to market entry? And I think it would be appropriate to start with you, Jim, as an actual practitioner.
I think it's interesting that we just start talking about regulation and without actually looking at supervision. One of the things that we have to ensure in the markets is that smaller markets aren't left behind in financial market integration. It's absolutely critical, right, that markets, particularly in Eastern Europe, don't become a tracking error for allocation of investment. And so there are a number of dimensions to the regulation and supervision. The first of which is that it has to be cost effective and it has to be relevant to the development of the market at the time. The second area, and it's not terribly obvious, is that even though we look at consistency in terms of regulation and supervision, if we look at how it's done in the various markets, it's not consistent. Some regulation is much more hands-on than others, and then other areas tend to adhere completely to EU standards or believe that they do, but they actually don't reflect it in the supervision. So it's very, very important to remember that with this integration process that we've seen over the last 20 years, it's largely about cost. So the cost has to be relevant to the amount of interest that an investor or global investor will put into the market. And I think that a lot of people have tended to lose the perception of that, particularly countries outside of the Eurozone that have tried to implement according to EU regulations almost immediately. And perhaps it's not appropriate to the level of development that they have at this particular point in time. The example that I like to cite is that, particularly in Eastern Europe, there's very little business case for the establishment of a CCP, for instance. There's not a lot of derivative activity, there's not a lot of option activity, and yet people have tended to fall over themselves to try and create a CCP. The business case was most strong for a regional CCP, but everybody in Eastern Europe said, well, yeah, we'd like a regional CCP, but it's got to be in my country, which defeats the whole purpose of it. So we have to look more closely at regulation and whether it allows international investors the type of freedom that we perceive that regulation does. And in some cases, I think we have to say that it doesn't actually cover that.
So, you from a regulatory perspective, Vojtěch, what is your view on that? And in particular, this question of the business case and the proportionality of regulation?
Thank you. So first of all, I would start in a positive way. I would say that we have achieved quite a lot since the both Giovannini reports and since Lamfalussy. We have a system of supervision in Europe, of coordination of supervision. We have supervisory convergence, which is functioning very well. We have harmonized rules. We have created many new tools tackling the barriers which have been described in Giovannini. We have target 2 securities, where Czech Republic is not participating in a way, but it is functioning quite well. So many barriers have been already removed, but many barriers are still remaining. I would distinguish barriers which are connected with the market, capital market integration, where it is not only about financial regulation, but also about regulation in other areas. I would say, for example, tax regulation and the differences in tax regimes across Europe are a very important part of this debate. Withholding tax, for example, but not just this. There is a lack of harmonization in civil law regimes, where even our colleagues from ministries of justice across Europe are not very willing to do something here, but we really need to do more in insolvency proceedings, where already the European Commission has started some initiative, but in my view it is not enough. We don't have common definitions of key terms like security, for example, or like shareholder, where we have only common standards but not a legal definition, which is also making the situation not easier. And there are also direct barriers connected with the market entry, as still complicated listing rules or prospectus rules, where we have also a new initiative by the European Commission within the framework of the Capital Market Union. We had a panel on ESG before. I would say this is also an issue which is quite complicated, because if the rules are too tough here, even in particular for SMEs, it is also quite hard to expect from them that they will be very willing to enter the market if they have to comply with all the new corporate sustainability reporting rules, with corporate due diligence directive, which is quite new and also very complicated. and another new rules. So we should, I think, also look into that. But to end also in a positive way, I'm happy that the European Commission is quite active in last years in the Capital Market Union framework, and that there are many new initiatives tackling some of the barriers. I have already mentioned some of them, but there is also the ESAP, the consolidated tape, the review of MiFID, MiFIR, and other initiatives.
Quite an alphabet soup there indeed, but it's interesting to hear you talk about the need for political convergence in order to achieve regulatory convergence, and we'll come back to that for a moment. But Indars, your group, Nasdaq, has done a huge amount to integrate markets in Europe, so very much as the targets, if you like, of from an outcomes perspective of political action. So how would you describe the journey that Nasdaq has been on in terms of overcoming these barriers and achieving a level of integration?
Yes, I agree to what was said, that for smaller markets that are sometimes overlooked, it's perhaps even more important than the big ones, that we do maximum we can and make it as easy as possible for foreign institutions to enter our markets. And this is also well understood by the local market community, that, you know, foreigners would drive the demand and grow the pie bigger, because alternative might be that companies seek for capital elsewhere, like going to London or similar. So this is understood, and I believe we as infrastructure, we have done quite much maximum that we can do to integrate the markets. Before we merged the individual markets into Nasdaq CSD, actually we ensured like cross-border DVP real-time link between the Baltic countries, including even stock exchange trades, so to facilitate the cross-border activity. Then we took it to the next level by merging 4 markets into one, and that is despite, like, Iceland is out of T2S and has Icelandic krona. We have 2-tier accounting model in Lithuania and Latvia, and end investor model in Estonia and Iceland. Despite those differences, we've managed to operate the markets with one CSD, with one IT solution. Having said that, we still see that the barriers are there. To some we can respond, like still very limited local custodian, service for the foreigners. What we do is we step up and we also provide asset servicing, so that there is alternatives that's appreciated by international investors. But I mean, there are topics we've been talking about for the last 2 decades, like insolvency rules lead to very expensive due diligence and analysis. Taxation rules lead to different withholding tax regimes and reporting requirements to local tax authorities. Company laws lead to differences in issuance process that hinders the IPO market. These are the challenges that need to be continuously addressed. And again, despite some efforts, to mention Shareholders' Rights Directive, we can still see that, the votes that are passed through the intermediaries may not be accepted by enterprise registry, or if there is investors behind the omnibus account, they require some special registration locally with local security, social security number and things like that, just to be able to vote. So still a lot of regulatory barriers.
Good, and Abdulla, you've been engaged in an exercise of integration, cross-market integration outside of Europe without a lot of this sort of political backstop that has created the momentum or helped to create the momentum in Europe. So what has your experience been, and what barriers do you find the most pervasive?
I agree with my colleagues. I think barriers can never be eliminated. And I would call it, I think you ended with saying regulatory barriers, and I emphasize on that part. Let's not forget that for each jurisdiction, there are kind of commitments towards, let's say, World Bank. We have the FSAP program, Financial Sector Assessment Program. There are principles that we have to be committed. Let's not forget the KYC, regulations, anti-money laundering, and that comes from the FATF. Since we are a full member, that we need to make sure that all of the principles are complied with. And one of the challenges would be the fragmentation of the market. Number one, corporate versus retail. And to onboard, let's say, a market entry for the foreign institutions, there's lots of due diligence requirement that is should be in place in order for an institutional investor to be onboarded. On the other hand, retail technology always supports the digital onboarding. In our scenario, we made sure that regulatory burdens, or let's say barriers, are taken care of. In our jurisdiction, the foreign ownership restriction is open up to 100%. In our scenario, that the cross-border transaction, it's allowed up to 100%. So going back, yes, I would only call it regulatory barriers, and we should respect, but at the same time, we should make sure that no international principles are, contravened, but at the same time, we have the digital market onboarding efficient and streamlined.
And you raise a really interesting point there about barriers to not just cross-border investment, but domestic investment. And we had a panel on this topic, basically. It had a different title, but at the ISA Symposium in Wolfsburg last week. And what struck me there, Abdullah and colleagues, was that the focus was, from some of the larger domestic markets, really about lowering barriers to entry for the younger demographic, and much less about opening it up to global custodians and sort of East Coast asset managers. Does that gel with your own experience, or is it just a contemporary form of protectionism to focus on the domestic barriers at the expense of cross-border barriers?
Mark, I think maybe you touched upon the omnibus versus segregated account, if I'm not mistaken.
One of the dimensions, indeed.
Okay. In our jurisdiction, we were open, but it is more challenge when you have segregated account onboarding. For the cross-border transaction and integration with the cross-border marketplaces or market infrastructure, it would be much easier when you have omnibus account structure. With segregated, and especially in our region, the clearing houses of the CSDs, they have more responsibilities because we deal directly with the individual. And when we look at the ownership, usually institutional are 80% and in retail is 20%. But number-wise, it's vice versa. 80% are retail investors and 20% are institution.
Good. That's something we need to watch, isn't it? Because indeed, for many markets, then the source of capital necessary to fuel growth can arguably be supplied by the demographic rather than by tapping the grey hairs of the United States and the EU. But to that point, Jim, there is some evidence that investors will acquire exposures even when regulations are not streamlined and defer doing so even when they are streamlined, if the case isn't there. So to what extent is this really just a question of following the money?
Well, generally speaking, investors will follow the trend, right? You know, that's the nature of the beast. But basically, if they see the barriers to entry, right, particularly in small markets, they'll look at it and they'll discount moving into those markets in general. On the question of institutional investor base, the other thing we have to remember is that it doesn't really matter whether it's a domestic investor or an international investor or retail or otherwise. The thing that we need is diversity in terms of the investors, because a very famous World Bank study many years ago said we need to have something to sell to or somebody to sell to. So a retail investor needs to be able to sell to institutions when they're interested, and a local investor needs to be able to buy when international investors are leaving via the escape route. So there is all this type of variation, and so the question there is, right, to talk about the access, general access for pretty much everybody. You know, the thing is, right, that if you don't allow inward investment at all, what you will get then, and it's what we've seen in Eastern Europe, is a concentrated banking system, which actually doesn't help capital market development at all. So the reality is, right, that yes, they will come in, and we've seen a very, very good case of this in countries like Serbia, where there's been a lot of involvement in buying government debt in Serbia over the last 5 or 6 years. But the reality is that at some point in time, that's going to slow down, and at that point in time, it's more important to have the investor diversity rather than the individual investor barriers to entry. You know, this is a very, very difficult situation because a lot of people are trying to protect their own turf. But a lot of people don't realise, right, that by protecting their own turf, they create a smaller pie, not a larger pie, right, for everybody to be involved in.
Vojtěch, what's your perspective on that?
Thank you. I wanted just to have a small remark concerning this question, following the money. We are now expecting, after long years, the initiative from the European Commission on retail, the European retail investment strategy. I'm quite wondering what will be there, but the general remark was that from the point of view of the retail investment, if the regulation is too overprotective, I would say, and the regulation tends to even to protect the investor against his or her well-informed decision, then the outcome may be that the investor will not seek for a very safe regulatory environment, but he will simply go outside the regulated area at all. And this is what is happening now, where even the retail investors are going to invest into the crypto area and or outside Europe into less regulated areas, which is very simple with digital investment. And then even the European capital market is simply losing the money, and the SMEs. This is the outcome. So therefore, I would be quite cautious concerning too overprotective regulation concerning the investor protection, in particular the retail investor.
So we've got onto the P word now, and this question of protection was always the underbelly, if you like, of Giovannini and Lamfalussy, and to the extent that, for example, in the European Union, CSDR addresses the governance of CSDs specifically and expressly with a view to ensuring that soft barriers to competition are not erected. So that implies that the presumption, the assessment that sits behind those sorts of requirements is that it is the local institutions who will protect access to market infrastructure, potentially with the unintended consequences that Jim and Vojtěch have spoken to. So, Indars, from your perspective, is that Is the local investor base playing a critical role in globalizing access to your markets? And how do you address that?
I'm not sure in terms of that the local investors are really local and they are so sort of home bias that it is very important factor to take into account. And despite all the integration that we have in the Baltics between the three countries, we still see like 80–90% of trading and settlement activity within that local country. I can give even an example that, for example, we facilitate IPO subscription process via the CSD service, which I think is brilliant concept because it requires the particular investment bank to give up the ownership of that one IPO for the broader good that everybody in the market can subscribe. And there we ended with one Latvian company in IPO having half of investors from Estonia and the other half from Latvia. And after some time you still see that actually the majority is coming back to Latvia, and there is the retail base. So they are very local. For financial intermediaries, there is of course a role to play, to be open, not to be overly protective. They are very influential actors in local communities. But speaking for our region, they accept the future benefits, despite there can be some short-term negative effects maybe to their business. And we have very recent example also from Icelandic market, which was, despite relatively small country size, they were admitted to FTSE indices last year, and that was heavy process, overcoming different gaps, including on post-trade, but that's achieved, and now there is a lot of good inflow from foreign investors into the country.
And one of the consequences of that can be weakening the competitiveness of local sub-custody offerings. And we've seen that in Iceland, obviously, since the banking crisis. We've also seen it in Scandinavia, where you've often got just one or two providers left standing, and therefore a risk to the servicing of cross-border accounts. In other words, if there is no provider and you can't reach financial market infrastructure directly, you have a big gap in the market.
Yeah, we then do what we can do, like lift up our asset servicing services, despite it's of course always tricky, being in competition with your biggest customers, but there is that approach.
Right. And Abdulla, what's your perspective? I mean, having in particular sort of been through this process in the Gulf, which you've seen a lot of progress, but you must have annoyed or at least disrupted certain entrenched interests in that process.
I think, Mark, in the mid-2000, we have seen during the financial market crisis, some of the capital market stakeholders, we witnessed that they've been reactive. But nowadays, we can see that stakeholders are really proactive. Today, we had a meeting with DB, the chairperson of AGC. She did mention that the US SEC are issuing, or they have already issued a document making the custodians accountable for any losses on the investor. For me, that was something new, and I think we as CSDs and clearing houses will get lots of pressures on global custodians and local custodians in order to make sure that we are in compliance with this kind of regulation. Let's not forget, we cannot just simply be in compliance with the local regulations, but also regional and international regulations. The role of the investor themselves also is very, very crucial, because they have to be fully aware of the risk associated of investing in capital markets. At the primary market, when it comes to IPO, the secondary market, and also on the post-trade services. So they have to be very attached. They have to do the follow-up, not just to rely on the local custodians and global custodians. The role relies on all of the stakeholders, starting, number one, on the shareholder himself, be it institutional or retail, and then it goes all the way to the regulator, whether local or international. Back to you, Mark.
It's interesting, thank you. We've, up until now, tended to talk about the integration being a good thing. And now we'll talk a little bit about how it might not be such a good idea. But before we do that, do we have any questions or observations from the audience? Yeah, Bruce.
You can't talk without the mic, Bruce. You need a mic? We can't hear you, Bruce.
Bruce, sorry, I understood that mics would be available in the room, and that turns out to be the case. Good. So Bruce Butterhill from AXTA has a question or observation.
It's really just a comment, and it's directed at Ken. First of all, Ken, thank you for your comments. I think... Jim. I know a Ken Turnbull as well. That's what my confusion. Jim, I think, Jim, your comments here about linkages needing to add value relative to their cost is a reminder that our history is littered by CSDs that have overbuilt linkages between markets that just created too heavy a burden to be overcome to actually build volume. And it's a reminder that we really need to be cautious when we link markets and take baby steps and build on that. Your comment regarding CCPs, they are not the answer for every market. In fact, they can put an unwieldy burden on a market that may in fact stifle growth rather than stimulate growth because of the nature of their market. I think as well it's a good reminder that investors don't come to markets because of the post-trade infrastructure, but they will stay away because of the post-trade infrastructure if we're not efficient, not cost-effective in the way we operate. And I think it's great, and we need to take this into the future for conferences. The more stakeholders that we can have coming and speaking to us at these conferences is a great reminder of what we should be focusing on and who we should be servicing. So thank you for that.
Super. And we have a question, I think, in the fourth row towards the center.
Thank you. It's Bev Furman representing Strait of South Africa. I just want to add on to Bruce's comment, and Jim, you've got the hot seat. You did make a comment that Eastern Europe didn't have a business case for a CCP. In the South African region, we're also doing the same consideration, and there's a very weak business case. But as Bruce mentioned, it's not so much that they won't come and they won't follow the money. But the comment was they may stay away if you don't have certain infrastructure. We also spoke about FSAP reviews, and for South Africa, we are a member of G20, and a condition of the G20 is to have a CCP. I'd like to pose a question to someone on the panel to say, if you're operating a CSD that is bound to adhere to those standards, and yet there is no business case, what should you do? You know, continue regardless or stand up against those standards?
I think you may have misunderstood what I said regarding a CCP. I think there would be a case for a regional CCP in the area. And one of the things that you're mentioning, and particularly about South Africa, is its role as a service or a service destination for the rest of Africa in terms of equity offerings, etc. So there could particularly be a case for a CCP in Africa that doesn't exist elsewhere. The point we were making was that there is a case for a regional CCP, but possibly not for an individual country CCP, and certainly not for 7 individual countries in Eastern Europe. That doesn't make a huge amount of sense. If you want to have a look at a good news story regarding integration, I'm surprised it hasn't been mentioned. But MSCI, a little while ago, have actually committed to a single investor rating for the Baltic states, which is a reflection of the huge amount of work that they did to integrate their market. And what it does is it addresses my famous expression, the tyranny of size, because 3 markets together, right, creates a business case for investors to look at a market which previously they would not have looked at. So there are positive benefits from integration, but you have to manage this process, and it has to be, going back to the point that was raised earlier, it has to be proportionate. You know, lumbering a market with an expensive form of infrastructure is as destructive as not having any infrastructure at all.
Thank you, Jim. Very interesting. And by the way, you even have markets which comply with those rules that don't have their own CSD. Ireland, for example. It creates complexity, but that complexity is absorbed in that particular case by our expert friends at Euroclear and the central bank. I'd now like to talk about the possible externalities of interoperability, and perhaps the most obvious and timely example is that the political action towards Russia in the context of the war in Ukraine has effectively compelled the market to unpick in emergency mode the interoperability that it took 30 years to construct. And whilst not wanting to discuss that, we noted that we're living through a period of banking, what an optimist might call mini-crises. And in that context, and looking at it from the perspective of sovereignty and pro-cyclicality, then greater financial market integration can obviously lead to contagion. So Vojtěch, what's your perspective on that? And how do policymakers and participants actually find the balance between those competing objectives?
Thank you for this question. So I fully agree that a more integrated market really contributes to the procyclicality. That's obvious. What we can do as regulators against the risk of contagion is to strengthen the risk management practices, to have clear rules on banks and other market participants on the concerning the prudential requirements. I think here I would say, for example, that I'm quite reluctant concerning some tendencies to relax prudential rules just for political reasons in recent years. Talking about even the SMEs and SME supporting factors, or which is discussed now, the ESG supporting factor, I'm always quite cautious if a political sphere or political preferences are going into the prudential regulation, which should be really based on the real risks which are in the banking sector, and therefore for me the prudential regulation should not be compromised, let's say, by the ESG. What we need is also strong supervision and cooperation among regulators, not only at the European but at the global level. And I would say that even if we have since a couple of years the never-ending discussion on breaking the vicious circle between the states and the banks, this vicious circle is still existing, and even the resolution framework which has been introduced in the EU is, in my view, is still not working sufficiently. Therefore, I'm wondering what will the next discussion on the revision of the BRRD bring. I think it is going in the right direction, but what we need, for example, at the European level, is change of the state aid rules, which are still detrimental for solving bank crisis, because the states then are tending to to use possibilities given by the state aid and by the discretion by the Commission, and therefore they are not following the framework of resolution as it was prepared. So this is a problem from my perspective. And the same is what we can see in the US, this interconnectedness between state and banks.
So your point is be careful, because a lack of integration or insufficient integration cross-border can actually be more pro-cyclical because it introduces fragility or deprives, if you like, local markets of resilience because of the interrelationship between local investors, local participants, and local issuers, notably the sovereign. What was your perspective on that, Abdulla? Across the Gulf, this discussion must have come up as well, that the extent to which you trade off pro-cyclicality against contagion risk. So my question is that where you have market integration, you, in principle, policymakers often fret that this is pro-cyclical, that this can be an avenue for spreading contagion. Has that discussion popped up at all in the Gulf?
Not really, not really.
No. Good, okay. So, Jim, what's your perspective? I think you were quite concerned as to what banking crises might do to this narrative.
Well, I guess it's no secret that Ukraine is one of our biggest clients, right? So, you know, obviously we're very much at the forefront of this crisis, this war, and the ramifications that it has. Is integration dead because of it? No, it's not, right? What we're seeing now is we're seeing integration in silos, and I know that sounds counterintuitive, but it's still happening, right? We're still doing integration within the EU. We're still trying to link regulations in various countries through IOSCO and all of these areas. But we do need to implement sanctions against rogue institutions and countries, and that needs to be accepted as a matter of course. As to whether they're effective, the jury is definitely out. We've seen ineffective sanctions applied pretty much globally, right, over a period of time. But given the limited amount or limited arsenal that you have, the biggest protection for you is probably financial sanctions against repressive regimes. So because of that, we just have to accept that that's something that's going to happen, and it does cause fragmentation. The bigger question about mini-crisis, and these aren't mini-crises, is the impact on the banking system. You know, the biggest thing that will hold this back is integration, but it's also clarity of the resolution regime, which is the reason why the EU stepped in no uncertain terms after the Credit Suisse resolution in Switzerland, and spoke about the necessity for a uniform framework of resolution. Now, that's a very positive thing. The problem, of course, is that individual states may look after their self-interest if impacted within a crisis, and we need to be aware of that. But, you know, that in itself is an integration framework when you think about it. Uniformity of regulation is what we really should be seeking, or certainty of regulation is what we should be seeking during times of crisis.
One of the things that gives resilience in a more integrated market is obviously confidence in that liquidity can be raised. And key to raising liquidity is monetary policy. So to what extent should central banks permit, and I'm not going to ask you this, Vojtěch, I'll ask the others, to what extent should central banks permit foreign institutions to access central bank money, to access monetary policy?
Question to me? Yeah. Thank you, Mark. I usually wake up, you know, at 7 o'clock in the morning, and then between 8 and 9, I'm on my way to the office. I just received a phone call saying that a very high net worth person wants to meet you. And just ask, what's it about? They said it's about market integration. Went there, and I just realized it's serious. The decision makers were talking about to have integration, regional integration, particularly on the capital market. So they asked me how much time you need to do that. Usually with our alliance colleague in Nasdaq, we know that to build up a kind of technology to do this integration would take 1.5 to 2 years. So I said 2 years, and they said, you have 6 months and just have it done. I went outside the office and I realized it's serious. We did it. We have this integration recently in the region. We went live a few months ago. We have at least 3 markets in the region are fully integrated. As Jim said, it's a single market entry. That requires, as one of the challenges, to have a foreign institutions or non-local institutions have an access to the central bank money. So that's why we had to revamp our regulations in order to cater and have non-local institutions or regional to have an access to central bank money, because that requires a cross-border settlement as well. So I mean that was one of, I mean the initiative, it's called Tabadul, and which is an abbreviation, or let's say definition of an exchange. So it's exchange between markets. So the product itself called Tabadul. So far we have 3 GCC markets. The other GCC markets are joining very soon in 2023.
Super, thank you. And Indars, you run infrastructure where you have a mixture of euro processing and, as you mentioned earlier, non-euro processing. How do you see this question of access to monetary policy, access to the euro system, or access indeed to, in your example, the Central Bank of Iceland?
Of course, in home markets, you have the access, but whenever we've analyzed some business cases or hypothetical business cases in some other markets, that always comes up as a problem, that you are unsure whether the access to central bank money is there. And in Europe, the regulation sets very low thresholds, what can be done in commercial bank money, and when the settlement requires central banks. So yes, it's important that there would be that access available, and if it is, then that it would be as standardized as possible.
So let us pause there before summarizing and ask whether there are any further questions, in particular in relation to this question of the externalities or downsides to market integration, or indeed this lack of symmetry between infrastructure access and access to liquidity. Do we have any questions or observations on that? No, but then I will raise one of my own, which is there's a lot of talk, and I guess that we will have that talk later, about T+1, with, to sort of characterize this, with the political authorities running around saying, look, America's done T+1, we must do it too, or we'd be left behind. But to what extent is T+1 really compatible with greater cross-border access and integration? Is it just potentially a new barrier? After all, if you're sat in Asia and you're looking to invest and deal with New York, you now have a very considerable funding barrier, which, or you will have, which you've not until now had to confront. So, Jim, what's your perspective on that?
Given that I spent 20 years in Asia, I guess I probably should answer this. T+2, or the old spot transactions, as we remember, was actually established for a very good reason. It was to cover a thing called Herstatt risk, right, which was given the different time zones in payments between Asia and the US. The thing is, right, that's 30-odd years old now, and there's a lot of things in place, including CLS bank clearing, to mitigate against these concerns. So there is quite a strong business case for turning around and saying that foreign exchange transactions can be T+1, therefore there is no reason to assume that equity-related transactions can be T+1. The one thing that I would say against that argument is that what I've seen is a lot of American institutions in particular are resistant to the changeover internationally, because they see that there are some difficulties with settlement. And a lot of the American institutions have established their bases on the back that they're domestic, that they're catering to domestic savings, and that international investment is a part of that, but they don't want to assume additional risks in terms of settlement. I think we're going to see T+1. I think by definition we have to. And I think we'll see it globally because technology will allow us to do it. But I think it's going to be a little bit slower than people think it's going to be.
And perhaps should we complement it with more focus on how to bring FX to T+1, even for non-CLS currencies?
Yeah, well, FX is, in many ways, right, the CLS solution is very, very neat and keen. The biggest, I think it's still the biggest day of clearing and settlement was at CLS Bank, was the day after Lehman failed. I think there were $14 trillion worth cleared of FX transactions through CLS Bank. So there are these institutions, right, that do exist behind the scenes that are actually very, very effective for financial stability when we think about it. But with changes in technology, we have to assume that this is going to go to, that the settlement cycle is going to get shorter.
So very quickly now, before we turn to the summary, Vojtěch, T+1, helpful, not helpful?
It's definitely a difficult question. I'm pretty sure that we will have this discussion among the European regulators pretty soon. It just already started at a working level. There are definitely some pros. It will reduce the counterparty risks. It could lead to more automatization, retain global alignment. It's also a question how it works if you have T+1 in some jurisdiction and T+2 in other jurisdiction. On the other hand, if there is reduction of counterparty risk, there will be definitely increase in operational risks. Even for the time difference between US and Europe or other jurisdiction, but also because of the automatization processes, which will be totally necessary. So I think we will have to analyze these impacts and then decide what to do at the European level, and if the pros or contras will be prevalent.
Good. So we've reached, in essence, the end of our time. So we thought that we would finish this in a very opinionated way. So I'm going to ask my panel 2 questions, and you're going to answer them without offering explanation, right, as food for thought and discussion. So my first question, I'll start with you, Abdulla. On balance, having heard those arguments, is greater financial market integration a good thing?
I'll make it short. I would say yes.
Indars.
Definitely, and for small markets, very much so, but equally for Europe to be competitive in global arena.
Very important dimension. Jim, I imagine I know your answer.
Absolutely. Financial market integration is not only is it helpful, it's essential. The strength of the ASEAN +3 is a very, very good example of how financial market integration can be a financial stability tool.
Vojtěch.
Perhaps not for everyone, but from the perspective of the small open economy, definitely yes.
Excellent. That's very, very clear. And my next question, what is the top one action, but you have to choose different actions, that FMIs and all regulators could take to facilitate greater integration in the next 5 years? What is the one thing you would
Make it 3. So
you go. Only one.
I'll just make it short.
Said 3, but we're running out of time. So.
It's obviously regulation. I would emphasize on the settlement, which I recommend T+2. 3 is the technology. Thank you.
By which you imply use digital tools in that direction. Super. Indars, what's your one thing?
Continued harmonization in famous corporate action sphere, as an example, and taxation, access to FMIs locally.
Super. Jim?
Consistency and cost effectiveness.
Vojtěch?
from the point of view of regulator, streamline and harmonize regulation, but I underline the streamlining or simplifying also, and supervisory convergence, which is interconnected.
And streamlining being distinct, you may have different regulations, but apply them in a way which joins up, which is accessible. Super. I think you've been a wonderful panel. We're, I believe, out of time, if my timer is correct, or we will be in 1 minute. So could I ask you all to give my panel a hand, and we'll continue the discussion.